Yo, it's President's Day, baby. Wasn't gonna do it live. Now we're gonna do it live. It's all over the place. Let's get this camera right. It's a little fuzzy. There we go. That should be a little better. How's it going, everybody? Welcome to the show. The markets are closed today, so we're not gonna have any sensational real-time streaming data at the bottom, but you get to see where the market closed last week. That's a good start, right? And I just got into the studio. We're going to make love to the night here. I'm using a little bit of a different background, so I got a new light for the back here. And if you guys have watched the show before, this view is something you're used to seeing. I'm trying it to be a little bit dimmer in the background. I think it sets the sexy tone that everybody always wants. That being said, welcome, welcome, welcome. A lot of trash talking has been done online. If you haven't noticed, the increasing cadence of our posting on the social platforms has been done by design in order to captivate you and to bring you in, but more importantly, to share with you the real-time stuff that we're talking about behind the scenes, both Saeed, Rajil, and I having those conversations in real time before we decide what was going to put on the show that's dropping, like, for example, tomorrow. Episode 322 will be coming out. I'm going to finish pushing that to the social platforms today. And if you don't know, this show is brought to you by the team over at Fridays. Go to joinfridays.com, enter code HIGHER, and you will get a lovely discount. We will feel supported, and everybody gets a W. For those who are new to the show, I am a user of GLP-1s. I microdose as well as take NAD+, just for overall longevity, because your boy don't want to die. So, with no further ado, let's get into the show. And this was going to be a little bit of a social media heavy show. Let's take the markets. So we're going to take the market pulse of what happened where we were last week. This does take into effect a little bit of what's happened in the closing parts of the day. So we got a little bit of market close activity from where we left the show off last week. There is your current position. We're in a bit of a mixed day, right? There's no clear trend. Tech isn't leading the way. All these markets are closed, again, full disclosure. So we're not seeing a huge shift one way or the other, but we're not seeing a lot of headline risk either. And we'll get into the upcoming events which could cause that here in the not too distant future. We'll get into our synthetic volatility index, our proxy for the VIX, showing a strong 82. So we are in a calm position just ahead of normal. This is where you want to be in an ideal set of circumstances, but this can and does change based on what happens in the markets at any given point in time, because it's going to look at how the market's acting using the ETFs as a bit of a proxy for the bigger indices. Moving forward, we'll get into the Fed liquidity. This has gone back and forth. We've seen a little bit of improvement, a little bit of degradation, but we are in a restrictive position. The Fed balance sheet is continually flush with cash, but you got the Fed repo being used and Treasury accounts being tapped. So you have a net liquidity score of about 7, basically showing that we're setting a slight amount of money being pulled out of the system, which should not be a cause for any concern, because we just got an unbelievable jobs print, whether you believe that it's real or not. I do not believe that it's real. And we also got a pretty healthy, better than expected inflation score, 2.4%, 2.9%. So because we got those numbers, there is no pressure on the Fed to cut rates. And as a result of that, Chicago Mercantile Exchange has pushed out the probability of a rate cut even farther. We're seeing over 90% probability of no rate cut at the next meeting in March 18th. Let's go into the housing affordability matrix. I have had a lot of conversations about housing on Threads, on X, and on LinkedIn. And if you're watching on any one of those platforms, we're going to spend a little bit of time today going over the charts and the data to help break down and explain why it is that I've taken some of the positions that I have. And yes, some of them are intentionally provocative because I want to encourage a discourse, a collegial, educational one where we have a back and forth on what we feel and think. And I do fully expect that housing, because housing is such an important part of American subculture and money is tied to it, health, religion, fitness, these things, finance is one of them that people take as dogma. And yes, I expect people to have opinions, and yes, I expect to be inflammatory, but we can all learn from the way other people feel and or think. And that's what makes these platforms so special. So if you see this and it bothers you, by all means, let's have the discussion on social media, but let's do it in a respectful way. This is the main factor that surprises most people. It surprised me, frankly, when I first did this, when we put our charts together, that it seems to suggest that the supply constraint is not the limiting factor to better home prices or home affordability. That bothers a lot of people. JP Morgan's information that came out in mid-January suggested, and we're going to look at that today, that there's only a shortage of about 1.2 million homes, which is about a third of where everybody else put it. That's not to say that there isn't a shortage of homes, that there is. But unfortunately, it still remains accessible for most people on the national average. A commenter on Threads, where we do not stream this show live, recently said something to the effect of, well, in New York, it's not the same as it is, so who cares? There's tons of homes in Iowa or Utah. Yeah, I hear you. That's exactly the kind of feedback we want. Now, we did cover New York specifically on a previous show where we talked about how rare transactions are there relative to the rest of the country. You're not seeing a lot of transactional volume, properties switching hands. And because of that, I would say that I completely understand how that guy feels and why he felt the way that he felt. But the national trends still merit being looked at, and I can only pull this chart together for the national regions based off of the St. Louis Fed's data, which we've gone over on previous shows, is in fact dated. That is why housing is a lagging indicator. And it's part of, I think, the disconnect from what I would call traditional economics and the real world application of what things happen. In a traditional economic set of circumstances, you're typically studying the static effects of one lever because you need to understand how that one lever maneuvers everything else. But the reality of how we all live is that there's a multi cocktail of things happening at any one given time, and it's not just one lever. So in this particular instance, supply constraint is not the limiting factor. What is the limiting factor here is mortgage rates and home prices. And you could argue that those are both proxies for affordability, which is both a proxy for supply, and therefore prices will go down if more supply comes to the market. I've heard all the arguments. I get it all. I traditionally say that demand without affordability is not demand, and that really pisses off a lot of traditional financial pundits. And I get why. It's supposed to be provocative. It's supposed to be interesting. But it is supposed to make us think about what the root cause and driver is of affordability. And I say that with this conversation in mind that I think is important to share. Yes, supply drives pricing in a fundamentally narrow scope for economics. Someone's going to take objection that I said fundamentally narrow scope. That's fine. Here's what I'll tell you. Real estate is not the same thing as widgets coming out of a factory. This is a highly regulated industry. Look at Dodd-Frank, right? You need to show ability to repay. You have limitations and challenges on people's ability to repay that have a tremendous amount of credit background. So just because someone can pay for it doesn't necessarily mean that their credit is available to them to do so based on the current guidelines and infrastructure. That's why I say that it's much more nuanced than people understand. And this is one thing that I do have some subject matter expertise of. Formerly a chief credit officer for over a decade of a publicly traded institution, I can say that I have seen this firsthand in a myriad of different cases throughout consumers all over the country. And it certainly is not purely a supply-driven economic conversation. I'm sorry, that's just my point. If you disagree with me, I fully respect it. Let's have that conversation. But the fact of the matter is, there's more to that story, and we're going to unpack a little bit of that later on in the show. This week is going to be an interesting week. We have the macro Fed event schedule here coming up. The retail sales I'm looking forward to tomorrow. To me, that's going to tell me a whole hell of a lot about what's going on in the consumer's mind. And we're going to look at a little bit of the retail sector here coming up. FOMC minutes from the last meeting on 2/18. That's on Wednesday. That's going to be very, very important. And again, the black bars here are going to tell us what we think are going to be potential moving of the market events. And then later on Friday, we've got core PCE price index month over month and GDP growth rate over the advance. So I think the most important impactful are going to be the retail numbers and the FOMC numbers. I think this down here, the core PCE and GDP will be a little bit less impactful, but certainly those two are going to be very, very big. And then you also have some stuff sneaking in here, the mortgage rate indication. I don't expect there to be any benefit. Crude oil coming down here this week as well. So let's talk a little bit about some of the retail numbers. I think that the consumer is struggling. And I know that that meets with a lot of consternation depending on what side of the K-shaped economy you're in, right? It's not a surprise to me that you have pundits on this side of the aisle that say everything's fine, and you have pundits on this side of the aisle that says everything's terrible. I don't know that, and the other problem with this is traditionally speaking, and I don't want there to be people upset, is this is your 50 plus crowd, and this is your 50 and under crowd, or 49 and under crowd. So there's also an age and cultural and generational gap between the opinions as well, and it's creating a social divide that I think we're seeing really get ugly on social media. Now, discount that a little bit because I have to go back to my repeating themes here, and that social media does have something like the dead internet theory. So as much as we're getting trolled on social media in certain circumstances, or there's some pundits or proponents that one way or the other, you have to look at it from a little bit of a jaundiced eye in that, and I say that ironically underneath a yellow light, jaundiced eye in that you have to understand that the people that are attacking you or continue to provoke you on social media might not necessarily have the interest of yours at heart, or it could just be this just bot situation. So if you can parse through that, there still isn't a generational divide that I think is very visible, right? The younger crowd, typically, I'm using generalities here, and I know someone's going to say, well, that's not me. typically wants social notoriety and doesn't fear visibility, so they use their real names and their real pictures. It's the older crowd which tends to use the avatars of some type and some made up name and use anonymity to, I guess, be a little bit more visceral, if you will. In both cases, you get visceral people. Both cases, you get extremism and radicalization and all sorts of weird stuff and all these pundits. I'm not saying that either side's right, but because of this, you have this weird level of inhumane behavior between actual humans who aren't bots in this set of circumstances that I think you have to be very cautious of because it can be mentally toxic and taxing on you, even if you're looking at something as simple as the finance space, which is where I spend all of our time. So, back to the show. Let's go over some of the sectors before we get into the week. I'm going to make this show a short show as a reminder. And for those of you who want to comment, just remember you come across all the multiple platforms down here. I will come down here and see what we got here. I don't think anybody's really going to be online today, but we'll see. We'll see who we got if we got anybody. Yeah, nobody in the restream chat. LinkedIn's always got more people. What up, Instagram? How you doing, Ryan? Fancy faces. I see you, girl. Regil going live on a federal holiday. Yeah, I am going live on a federal holiday. Salutations, brother. Salutations right back at you. The whole point of the show is to get us ready for the week, and I figured, you know what? 30 minutes ain't gonna hurt me. I had to upload the show anyway for tomorrow's podcast drop, so I figured why not. Okay, let's get into some sectors. This is the housing and home builder sector chart. We're seeing DR Horton Lennar. This is rate sensitive. We're seeing the little bit of the treasuries rise. Actually, I haven't checked the treasuries today. Why don't we do that? Why don't we see where the treasuries are? And I'll pull that up real quick so you guys can see that on the screen. Here's CNBC. Let's go over to the bond market. Let's check out the 10-year. 10-year is down. Okay, look at you. Real estate professionals, mortgage loan officers, and realtors all over the country should be dancing around in emotional, happiness and joy, because that is a good sign for mortgage rates. If you want mortgage rates to come down a little tiny bit, look at that drop. Wow, 4.27 down to 4.048. That's meaningful. Look at that. Okay, and again, we show you these charts on CNBC because we want to have everybody to have access to the same amount of data that we do. So that this is where we go to look at things. It's very easy to do. I suggest anything you pick up on the show vis-a-vis osmosis or watching us do it, you do it throughout the day just to see where the markets are. I traditionally watch CNBC over here on the left all day long just because I'm old school like that. But certainly if you want to know where the markets are, we can give you that all day long on our own. Getting back to the sectors, here you have DR Horton. I'm not seeing a tremendous change in the housing side. What up, Sean? I see you. The Amazon box behind you killed me. you talking about that right there? Yeah, man. So true story, and it's a Monday light show. We can do this. Over here is a bunch of the audio cables and everything else that we use because this show used to be in another studio, and we changed and moved to this one after we built it. And this one contains the Amazon box that you hate so much contains a lot of the supplies from when we built the show that I've been reluctant to get rid of because I don't know what works and doesn't work yet. Like we're still kind of tinkering a little bit in the space. The audio in this room is a little bit echoey for my preferences, and that room is perfect. It's the one we built for specifically the podcast. But some of the lighting in here, we've been playing around with it, for example, and doing different things, and I'll show you exactly what I mean by that. So one of the things I've been really eager to do is to be able to try to change things a little bit more dynamically in the show. So if I wanted to do something like this and change the lighting, I could have the lighting theoretically change with the Chiron down below. So if we had a breaking news, I could change the back here to like a bright red like that. Or if we had like a sponsor segment, I could change it to green like that. And we could do it all in real time on the show to kind of give you a little bit more of like a in-depth dynamic feel. So that box contains a lot of the goodies that are going to help us do that over time. And I know that it drives you nuts, and I apologize, but it's out of love, man. It's out of love. It has been there since the first episode. If it makes you feel any better, I'm open to suggestions as to what to put up here. The problem is this space is actually a pretty small space and it's limited, so I don't know where the hell else to put it. So there's actually a box on the floor too, which would probably drive you nuts as well. Let's get into the sectors a little bit, and then I want to go into some XAI, the rhetoric. That's what's going to be the real meat and potatoes for today's show because there isn't a whole lot of market activity today because it is a closed day in the markets. Let's look at the bank sector right now. Banks are a bit neutral for the day. This is the credit conditions. I wouldn't expect anything to be revolutionary over the weekend. Credit markets should be about the same, flat. There you go. It's always nice to see these, by the way, when they work in a flat environment like this, because whenever I program and design all these things, they don't necessarily always show that way at all. So it's nice to see that I'm not crazy. Mega caps, this one should be interesting to look at. Okay, again, flat. That seems about right. I think the consumer should be up. Oh, no, wow, down. Okay, there you go. So consumer sentiment coming out. So let's keep an eye on these guys throughout the week. Again, markets closed. So, and I got to change this to include holidays. I know it says markets open, but markets are not open. It's just programmed on a time basis, not on a holiday calendar basis. So I will fix that. But there you have the retail sector: Walmart, Target, Costco, Home Depot, Dollar General. I think these will be very, very, I guess, dynamic, if you will, during the retail numbers that come out this week. So expect to see those pivot and change, and expect to see the response to that. For those of you who are bettors, that's what I would bet on for the week. Industrials, real economic signal right here. Again, relatively flat on the overall change. I don't think there's anything after hours that changed meaningfully throughout the day. Geopolitical supply risk. I'm actually surprised. I will be surprised. I want to see what this looks like on Tuesday at market open, largely because of some of the conversations that have happened with Iran, a nuclear deal, the U.S. moving Navy ships into the area, and some of the stuff that we've seen around oil and just electricity pricing over the weekend. So I want to keep an eye on this sector for Tuesday, as well as the consumer stuff as reports come out. Let's look at the defensive positions. This closed pretty much flat on the day as we expected. This is Procter & Gamble, Coca-Cola, Johnson & Johnson, NextEra Energy, Duke Energy. These are where the money goes when we're in a true risk-off environment. And I think we're, if not there already, we're certainly heading towards a risk-off environment. And because of that, we're going to start to see a little more defensive positions. Personally, I think that's what's driving a lot of the Bitcoin kind of route, is that people are going, in fact, they're going risk-off. And because of that, I think you're going to see cryptocurrency stay a little bit lower until such time as that changes. You don't need to take my word for it. Let's jump into it. Again, going back to CNBC, we're going to rock right over to the crypto top here. Go to Bitcoin. It is still below 68,000. Saeed, wherever he's at, is peeing himself a little bit with joy and excitement because he has wet paper towel hands. But for the rest of us, this is a meaningful change. You lost about 50% of your value. Michael Saylor, by the way, doubling down on just angry asshole. We can get into that, but he's really pumping hard. I looked at his numbers. He's not necessarily wrong per se in the stuff that he's saying, where he says that he can handle Bitcoin falling to $8,000 a coin, based on some of the leverage and financial position that I saw in his portfolio when I did a deep dive. But it does take into account some of the value of the organization and some of the other stuff. I will say, relative to the volatility, he does have low leverage, but certainly it's in his benefit to pump this as hard as he can and to give it strength that he needs in the markets in order to perform, because he's got really well, his situation going. So this is the forecast. For those of you who do not know what this is our proprietary model. It's going to go out this week. I should call it a behavioral economics model, but I call it the Trending Now AI analysis. And the reason why is this goes out to Instagram, it goes out to X, and it's going to scrape that. It's going to tell us what the leading commentary is in each one of the subtopics that it pulls for us. It usually pulls about 7 or 8, depending on the amount of volume. Then it's going to look at the AI insights, tell us what AI thinks about this, so you don't get my stupid opinion, because we know that I'm relatively useless here. And then we're going to look at the overall controversy score. Is this very much contested? Is there a consensus on it? And then the overall controversy score can tell you basically how likely it is to impact these markets. We know this, for example, this is spiked 280%. It's got a high engagement rate, and the risk level is moderate. It is a defensive tech position. So let's read it. SpaceX and xAI are competing for around $100 million Pentagon contract for autonomous drone swarming technology. This represents significant defense tech expansion for Musk's companies. Fascinating. I wonder how Palmer Luckey feels about that. Defensive contracts provide stable revenue streams, but regulatory scrutiny on Musk's growing government ties could create headwinds. I don't think that it will, frankly. Let's go to the next topic, shall we? Because we got lots of them. Let's see what X pulled down here. Data center power demand. Oh, who would have thought? I posted this something similar on the same topic. I wanted to say on Friday and Saturday. It was reached with a lot of pushback. We're going to look at some of those posts, a lot of the comments, and we're going to see what that really means. Global data center power demand expected to rise 255% by 2035 to 1,596 terawatt hours. That's a big number. U.S. demand alone projected to increase 144%, driven by AI infrastructure needs. Yes, AI is power expensive. Massive infrastructure opportunities for utility companies, but grid stability concerns could accelerate nuclear and renewable investments. As a matter of fact, I think that there is a whole lot of that happening. And you do know that some of the mega caps, most notably Google and I want to say Meta, don't quote me on the Meta part, are actively looking for permits in nuclear power to power their models, which they are working on. So that's a real thing. Apple Video podcast launch. I, for one, could not be more excited about this. Apple is launching a new video podcasting platform to compete directly with YouTube and Spotify. This represents Apple's push into content creation and distribution. Late entry into the saturated market suggests Apple may struggle against established players unless leveraging unique iOS integration advantages. And let me tell you right now, your boy is going to be all over this. And Saeed, wherever you are, I want you to know, brother, this this is what we're going to do. We're going to do this because your boy's in the Apple ecosystem for all the electronics and everything else, but I think this is a meaningful thing. So those of you didn't know, now you know. Market volatility divergence. This is a good one. Individual stock volatility is surging while index volatility remains subdued. And that's a fascinating point. Let's see what AI says about it, then I'll give you my thoughts. With the spread hitting highest levels since 2020, this is represented in our synthetic volatility index with the spread between individual stock versus the overall market. We actually actively monitor this in real time when the market is open. This indicates significant stock picking opportunities and risks. It does. One that makes me very nervous. I think there's a flight to the small caps, and because of that, it's pushing the market up still, even though the mega caps taking a bit of a hit and a ding ding. But there's also so much money in them that their proof of concept is going to be valid at some point in time. It's just when are they going to get there? High dispersion environments historically favor active management over index investing, but also signal potential market instability ahead. Look at this. AI telling you to invest actively versus passively. I don't know if that's self-serving or not coming from AI, but it's all good. There's a whole bunch here. Epstein's financial conditions. I don't want to get into that. U.S.-India trade relations, housing market recovery. This is an interesting one I saw earlier. Housing demand is snapping back as mortgage rates approach 6%. Let's see here. Actually, while this is going on, let's check out the 30-year mortgage today. Let's see. Okay, yeah. So bank rate has us. Okay, yeah. See, I hate when they make you fill out the forms to get information. It's like, I don't care. Let's go to Freddie Mac. You know, I love the Freddie Mac team. Have a tremendous amount of respect for them. Worked with them for a long time. There you go. 30-year mortgage rate, 6.09%. Rates down a little tiny bit. 15-year at 5.44. So we are approaching 6%. And believe it or not, kids, I know that people are going to be really upset with it. That's actually a sensational rate relative to historical numbers where it shows the historical average closer to 8%. So if you're seeing this and you're going like, shit, still 6%, that's a good rate. I know it doesn't feel that way after 14 years of artificial interest rate inflation and your neighbor's getting that 2.5% rate or whatever they might have for 30 years. But as Jamie Dimon would say, you got to live in the world you got. So that is what it is. So the housing market recovery is here. Rate-sensitive sectors showing resilience suggested market adaptation to higher rate environments, but affordability challenges persist for first-time buyers. Yes, they do. And with that, we will segue into a lot of the housing conversation that we have here. So I want to look a little bit. Oh, look at this. Jason from the All In podcast is quoting, of all people, one of my favorite pages, the Kabezi letter. Kabezi letter, U.S. job numbers were revised down by over 1 million jobs, 1,029,000 jobs in 2025, the largest annual revision in at least 20 years. This follows down revisions of 800-something thousand in 2024 and 306,000 in 2023 and so on and so forth. Yeah, these are big numbers. And we covered that on the show in depth. I think a lot of people were calling us fear porn mongering this stuff, but I don't think that it is. I think it's a real serious problem, and I think that there's a political disconnect here. So I don't necessarily know that that is in the White House or in the Fed, but certainly I think that the recognition of this, which was honestly the first person to really talk about this, was Zero Hedge. And they put out some really good analysis in a couple of years ago, going back on this stuff. They were calling this out pretty quickly. And now everybody, I think, is pretty much keenly aware. You'll find a lot of people on the social platforms very critical of this. And I think for good reason here. Let's check out my profile a little bit here. You can see us talking live during the live, which is also awkward for me too. I think this divide tells a whole lot. This is from my friend Mohammed Al Rain. I'm going to go into the screen view here. Share of U.S. consumer spending by age group. So when we talk about a K-shaped economy, this is not necessarily indicative of that, but what I think that it is a good proxy for what could become a problem later on. Again, I'm not trying to cause fear. I'm just saying these are the numbers, right? So let's forget the recession piece here. 54 and younger consumer spending is going down, while 55 and older consumer spending is going up. And if you've listened to this show or watched any of the financial information online, you know that one of the most common criticisms of the market today is that the wealthy demographic is carrying the not wealthy demographic in what would be a K-shaped economy as we see this middle class start to crunch down as first-time home buyers are not able to buy homes. They're buying, for example, stock. So what does that do? That creates a wealth gap where you have the wealthy and everybody else. And under this suggestion, the wealthy are spending more than they had historically. The wealthy older class, which owns assets, while the generally younger, and I say 54 is probably not. I'd like to see this chart at around 40, 45. First time home buyers at the age of 40 now on average. So that's where I'd like to see this data dispersed. But the point I think is made here is that the older populace is spending more money as the younger populace is spending less money. Again, younger and older being 55 and 54 here. So a little bit of a offshoot. But let's talk a little bit about the stock market. Here is a conversation that I had on social media not too long ago. S&P 500 long-term performance of stocks versus U.S. median house prices. Now, this might shock a lot of people because a lot of people go, well, home prices have gone up an incredible amount in the last couple of years. They have, but the stock market's gone up even farther. And I think that one of the problems that people have here is they look at their homes as an investment when, and we've told people a long time ago and continue to reiterate this point, your home, while it is the largest source of wealth creation for most Americans today, is the equity appreciation in their home over time, it should be purchased for utility because you need that to live and survive. That is why you buy a home. And yeah, if you want to make it a cash flow play, you can save more money renting. No argument there, but understand that that equity means very little to you until such time as you monetize it. It's similar to banks and unrealized losses, right? Until such time as you need to tap into those assets and sell them, whether it's underwater or above water, doesn't matter to you as long as you can continue to make the payment. We have Zillow, we have Redfin, so you have good proxies for the value in real time. But for most people, this value is something you look at 10 years later-ish, or whatever your average duration stay in a home is. And I think it's going to creep up due to the mortgage locked-in effect. But the S&P 500, however, because companies like Vlad at Robinhood were successful in democratizing the space, and you now have a retail trader who is investing in the stock market because they can't buy a home. So where does that saving or excess capital go that they can invest in? It goes into the stock markets. And frankly, for the last several years, particularly since '05 forward, they've been able to really make good money, good returns off that relative to their investments. And I think you've seen the continued profitability of these companies. Companies are making more money as a percentage of revenue and earnings right now than they ever have historically. As a matter of fact, in the last 70 plus years, companies are making more money than ever. So it makes no surprise to me that this is in fact where we're seeing the market. Now, do I think that there is a bubble to be argued here? 100%. The market's overvalued. The Dow's over 50,000. We all saw the memes. You got the NASDAQ approaching at all-time highs. You got the Dow at all-time highs. And you see all these things happening in real time. And you think to yourself, okay, well, everyone's so focused on the housing market, but there's a problem here, okay? And the problem is, if people go, well, okay, well, housing market's going to have a crash or a market correction. And I keep asking, what is that? That's where a lot of the fighting comes from on my social platforms. Keep in mind that housing has leverage. We're going to break this down mathematically. In the United States today, okay, 40% of homes are owned with no mortgage, which means 60% of the properties here, okay, have a mortgage, have leverage. I don't know what the numbers are, and I could probably try to find out, but I would venture to guess that people that own the stocks, particularly those in the S&P 500, are not typically on margin, certainly not the retail traders. And if they're not typically on margin or using leverage, or they're using less leverage than most people have against their homes, then I would argue this is actually a much more stable value proposition than people see it as. They just see these values going up. But if the values go up without leverage on them, then you know what? What's the risk? You lose the inherent value to you, that unrealized loss or unrealized gain, depending on when and how you sell these. But unless you are a retiree going into a 401k, you just have less stock value than you otherwise had. Whereas down here, you could not sell these to break even because you have debt to pay off, if that makes sense. I'm trying to be somewhat clear and I guess basic or colloquial, if you will. Let me check the comments real quick because I've been talking a whole lot. Oh, we got Sean out here. My first mortgage rate was 5.1%. That's not bad. That's not bad, dude. Question: what happens when? Let's take a look at your question here, Chiefy, because you and I think the only ones here today. Let's see what your question is. Question is: what happens when the boomers start unloading their homes and stocks with little buyers? Well, I guess it really comes down to when and how. It's all speculative, frankly. So I think that number one, as of right now, unless something were to happen that dynamically changes the environment, I don't know what would cause a correction or a crash by any stretch of the imagination. I think that a lot of people on social media seem to suggest that's necessary. Maybe. But after 14, 15 years of artificial interest rate deflation, a prolonged period of prosperity in the United States, I could make a compelling argument that you're going to see a longer correction over time is probably going to be your best and most likely outcome, where it'll be a slow, painful effect. A lot of the aging populace will age out of their mortgages. They'll either pay them off, or they'll die, or they'll want to sell and retire and move on. But I don't think this is an immediate thing. I think it'll happen slowly over time. And where mortgage rates are at that time is anyone's guess. Right now, you're seeing mortgage rates drop back down. And if you're seeing mortgage rates drop back down to, call it 6%, that again is still a healthy rate. But what this does allow us in this prolongated solution theory is to solve for what I think is a bigger problem in wages. In wages, Sean, I'm glad you brought that question up, I think remain to be a pretty meaningful problem. So let me clear this off the screen real quick, and let's go over to the social view. This is a post from myself, but I pulled the data from other places. We always say on the show that homes will be more affordable if rates come down. Home prices came down or wages went up. We can argue supply and demand all day, but are we really addressing the problem? In 2005, the median salary was $44,326. In 2005, the median home price was $220,000. In 2025, 20 years later, the median salary is $56,292, while the median home price is now $420,000. So you can see clearly how home price elevated pretty quickly, but wages did not. So my hope is that, Sean, by the time we get to that period of time where you get this generation who is now selling assets down, is that we, the people, as Said would say, now have wages that have increased enough to offset at least part of this. And there is an entire group of people who are going to be watching this show saying, they don't feel bad for people and they have all this. I do. I legitimately feel bad for the population that has to deal with this, because the ramifications of it are very challenging. And I think that it's something that should not be ignored. I'm going to go to another chart, because on the same topic, I think is important to note. This here is a chart. I'm going to pull up the big one here. This shows you multiple job holders. So because we know that wages are so restricted, we also have a situation. This is also kind of one of those quirky reporting functions where I don't think we get the true nuts and bolts of people reporting this, because there's so much stigma to holding multiple jobs. I think the idea of holding multiple jobs got demonized a little bit in the pandemic, where people had two full-time jobs, one of which they weren't disclosing to, the other one they weren't disclosing to, and everybody was kind of working around these people's calendars, and efficiency went down. And I'm not saying that that's appropriate or right. As a guy who worked at a company that's publicly traded, we helped start that thing. I don't think that's ever a good thing. But do I think that people have multiple jobs, working 9 to 5 and then 5 to 9? Yeah. Do I think that people have side businesses and side hustles? Well, according to the data here, more people than ever. And I think that's an important factor to think about here. Multiple job holders, primary and secondary jobs, both full-time. There's a little bit of volatility here again, but you can see the generalized trend is in fact going this way, because we went from single income households to dual income households to now needing 3 jobs just to meet the necessity demand. And I think that's the big differentiating point here, is that necessities, healthcare, food, are very expensive. And if they're very expensive and people need those things, hence the word necessity, they're going to find a way to pay for them. Now we have credit cards at an all-time high dollar amount by proportion of total non-household debt. And they're at a 12.7% default rate, second highest only the Great Financial Crisis, which is in the 13% range. So certainly there is some strain here that is manifesting, and what that ultimately looks like is anyone's guess. Pundits could argue that those who are fortunate enough to own homes have more home equity, and a lot of mortgage loan officers I talk to are telling me that's their number one selling product right now, because of the mortgage lock-in effect, and people don't want to sell the assets they've got plenty of, if that makes sense. So I think there's a whole lot there still to be said. So I said a 30-minute show. We're about 36 minutes in. I did have some more to go over today, but I think, it's a Monday light show. Let's call it what it is. I appreciate those of you who did join us both on X and on LinkedIn and on Instagram. Let's check out the Instagram side. Rajil, I appreciate all the comments. Welcome, Level 9 Studios. I love you out there, brother. You guys do some amazing work. And anybody who's ever gone to Vegas and seen a great podcast, it probably came from my guy's studio over there. And for the rest of you, happy President's Day. This will be on all platforms, LinkedIn, X, YouTube, as well as Instagram, although I typically don't post the vertical format to Instagram just because it's a little bit harder to read. You can always jump over to any one of those 3 horizontal platforms and check it out there. But unless anybody has any other comments, I'm going to check a couple more comments here in the last couple minutes. We're going to call it a wrap for today. DoorDash and more things. That's exactly right, Sean. That's exactly right. But we jump back into our normal live times 11 a.m. Monday, Wednesday, Friday. Starting back again on Wednesday. If there's anything you would like to see us talk about on social media, we are always looking for good ideas to help us out. And as a reminder, for those of you who stayed this far, we love you. We appreciate you. This show is, in fact, brought to you by the team over at Fridays. Go to www.joinfridays.com. Use the code HIGHER, and you will get a discount. We will get some love, and it makes everybody feel all warm and fuzzy. Tirzepatide, longevity drugs, pretty much just trying to make you a healthier person. Until next time, everyone, we love you. Bye.